Mind Your Farm Business on RealAgriculture.com is brought to you by RBC Royal Bank.
Welcome to the Mind Your Farm Business podcast, brought to you by RBC Royal Bank. I'm Sean Haney, founder of RealAgriculture.com and host of Real Ag Radio on Rural Radio 147 on Sirius XM. You can find more episodes of this podcast by going to mindyourfarmbusiness.com. Today's topic on the Mind Your Farm Business podcast is all about the Canadian dollar and managing exchange rate risk. Due to the fact that many grain prices are traded in U.S. dollars on U.S. exchanges, this creates a currency risk for Canadian farmers. Many farmers pay attention to crop prices, weather, and other factors, but sometimes ignore currency risk just a little bit too much. How you hedge the Canadian dollar exchange rate can have a major impact on your net farm price, so ignoring it could be at your own unprofitable peril. Today's guest on the Mind Your Farm Business podcast is Matthew Pott of Grain Perspectives. Matthew is a commodity analyst and economist who advises clients on managing pricing risks. Here's my conversation with Matthew. Hey, Matt, how are you?
I'm good, Sean. How are you today?
Hey, great to chat with you. You know, Matt, a lot of times we focus in on the futures price or the cash price of the commodities that we are producing. But in some of these crops and commodities, the Canadian dollar, the exchange rate, it plays a big role in the price we actually get at the end of the day. We have to pay attention as farmers and ranchers to the currency. It's absolutely critical.
Absolutely, Sean. It's an integral part of Canadian crop prices and livestock prices. It's what makes marketing in Canada so different than the U.S.
Yeah, good point. So, Matt, what are some of the things, the variables that we really need to be paying attention to when it comes to putting together our strategy on the Canadian dollar? It has moved in up and down significantly here in the last 12 months. There's been some serious variables, some of them expected, some of them not expected at all, like COVID-19. But as we look ahead, what are some of the things we need to be paying attention to as we try to come up with our opinion on the Canadian dollar?
When it comes down to your opinion on the Canadian dollar, when you look at the Canadian, what's the driving factor of the Canadian dollar, Sean?
Well, I think some people would say it's the price of oil, but I'm not sure it's as heavily weighted to that as it once was.
And since the global pandemic started, or when things actually hit the fan here in North America, it's all been about the U.S. dollar. And in general, you could correlate that to equities too. And so when you look at the U.S. dollar index and the Canadian dollar, it would have like a 90% correlation, 91% since March. And over, how long ago is that now, Sean? We're over 7 months, right? So those are pretty significant data points. Crude would be closer to around a 71, 72% correlation on closing prices and their relationship. And so there's bigger things at play right now in the currency market.
And so is that bigger thing just the overall sentiment direction of that U.S. dollar? It's really about U.S. dollar weakness or strength that is the more important factor, or what are your thoughts?
Right. And, when we saw that first initial fall, it's so long ago, it seems like a decade ago. Do you remember March? We saw that fall, and we saw that fall to around 68 cents, right?
Yep.
And a lot of that had nothing to do with our domestic information or whatever else. Sure, it had something to do with crude at that time, and the fact, obviously a global pandemic is going to slow down crude demand, but a lot of that had to do just with severe liquidity problems in the U.S. dollar, right? And ever since then, this Canadian dollar has been a risk-on, risk-off currency, right? And that's something that we have the U.S. election ahead. We're not even done 2020 yet, Sean. We don't know what can happen yet. This is an odd year, right? And so when you're looking at the Canadian dollar, it's all risk on, risk off. And that's it's going to be a result of, equity markets, the U.S. dollar, what that means as a result of liquidity, and then what it would do to the Canadian. So I would expect that we're very much going to be inverse to, we're going to follow along with equities for the most part, and then we're going to be inverse to the U.S. dollar, and we're kind of going to put crude by the side, and at least for the time being.
So how long does that last for? Is that kind of undetermined? That's the market sort of sorts that out.
The market will sort that out. Like the problem with crude right now is the fact that we're stuck in this sideways trade that I can't. Can you see a way out of this or a timeline out of that sideways trade? We're more or less around $40 WTI on the nearby, and that's where we've been stuck.
Yeah. So, but we can't forget about it. Like you said, it's 70% correlated. I mean, maybe break that down. What does that actually mean?
If you just take your closing values and you plot them out against each other and put a line across it, I guess more or less, it's just correlating regression. But it's just looking at what's making the moves. But now, when you look at and this has always been my case with the crude in general, right? Is what comes first, the chicken or the egg? Is the Canadian dollar correlated to crude because of crude being a major exporter, or is there major other factors that are influencing the crude market, such as why the U.S. dollar is higher or lower? And there's bigger pictures. And so when you look at the Canadian dollar right now, you're looking at it's risk on, risk off. And then after that, Sean, after we get out of this risk on, risk off, like, will it jump back to a correlation in crude with what the Federal Reserve has done in the U.S.? That's not even a certainty that we even see that kind of relationship like we have in the past, right? You look at, when you look at the Federal Reserve continues to say that they will do whatever it takes to keep this U.S. economy stable. Right now, we have a lot of problems on the U.S. stimulus. Like, what's your thoughts on that, Sean?
Well,
and when does that get resolved?
Well, and that's what, Matt, I'm glad you brought up the Federal Reserve, because right now we're at a point where interest rates in both Canada and the U.S. really can't go much lower, if at all. There doesn't seem to be the willingness or the desire to go to negative rates. So there's only one way to go up, but that doesn't seem like we're going to reverse course very, very quickly. So it's even hard to talk about interest rates and fiscal policy when it comes to trying to figure what happens to the currency, at least in the short term.
Well, when you look at the U.S. dollar, which is a globally dominant currency, I think we agree with that, right? Yeah. And you look at the Canadian dollar, the question we should be asking ourselves is, when we're looking at the Canadian dollar, when we're right next to such a big dominant currency, what means more, our fundamentals here in Canada or the fundamentals of what's going to happen with the U.S. dollar long term? We're such small apples. We're a loosely traded currency compared to the other side of that currency pair. We're a pair, and that's something to keep in mind. And when you look at the Federal Reserve, we can talk about interest rates and all that stuff, but those interest rate correlations as far as currency markets are concerned were more relevant than 2 years ago. And now we're going to look at it, and the Bank of Canada has said that they won't go into negative interest rates, but they're not ruling it out, right? And so we do have other questions there, but when you look at the Federal Reserve, for instance, and what they've done with their balance sheet and what that has meant for money supply in general, like M2 money supply would include your checking account, your savings account, basically anything that where cash can become liquidable very quickly, right? And that has increased. The U.S. M2 money supply, U.S. dollar M2 money supply has increased 22% in 2020. Now, when you think about it, that's printing a heck of a lot of money.
Yeah, no kidding.
And so when you look at this, those are big factors that we don't know about the risks and where this will end up as far as what inflation is concerned and all these other things. And what makes it so difficult on navigating the currency market at the same time is, like, it seems to me ever since we got into this pandemic, and the U.S. stock markets illustrate that clearly, is that we're going to try to just hide everything, all the damages that have been done. And this could also be something that eventually catches up to central banks 5 years from now. We might actually not feel the impact of this pandemic for 5 years either, Sean. So I guess what I'm saying is there's lots of moving parts in the short run that are going to create like a choppy Canadian dollar. And then once you get into the longer run, the U.S. dollar could be under some fundamental risk at the same time.
We'll get back to my conversation with Matthew Pott, but first, a word from our sponsor. This episode of Mind Your Farm Business Podcast is brought to you by RBC. While there is no way to eliminate all business risks you'll face, creating a sound risk management strategy will help you mitigate some of the more common ones and give your business a leg up. The agriculture account managers at RBC can help set your farm up for success. Visit rbc.com/risk management to find an ag specialist near you. Are the dollars of, or the currency markets, I should put it, of some other countries of our same economic size, like like in Australia, are they facing the same exact sort of discussions there right now in terms of the direction of their currency, or is it like, is Canada unique at all, or just kind of the same as everybody else as it relates to the U.S. dollar?
I think when it comes down to, when it loosely traded currency that have a trade flow, like Australia would be very much similar to what Canada is from. Now, I don't follow the Australian dollar very closely, but as far as I would look at that intuitively, I'd say that they have the exact same questions that they need to be asking themselves, right?
Yeah.
Is what happens to this U.S. dollar long term? I mean, you look at it, this U.S. dollar is all this risk. And when you see that, you see it on any risk on trading day. The U.S. dollar seems to find a way to, people still want to put money or just want U.S. dollars in their hands, right? Indirectly, of course. But so you look at that and you look at the risks that we know right now. I guess my point is, if everything went even keel tomorrow and everything was fine, what could that mean to the currency markets and the Canadian dollar, for instance, right? It could definitely mean that our Canadian dollar is underpriced if everything was normal tomorrow. The good news is that that's not going to be the case, though, Sean.
Are there any other variables, Matt, that are important to look at when we're thinking about the valuation of the Canadian dollar?
I'd like to keep it really simple and look at the total risk on, risk off trading, right? I think you can't argue with what that correlation has been as far as what the risk sentiment has meant to our currency. And obviously, crude's going to have some impact on the side a little bit, but it's not going to be your leading indicator as far as I'm concerned. I think we're looking at your global risks that we're in, right? And these second waves and whatever else that means to the long-term global economy. We have to remember that we're a trade economy, right? Or at least we should be. And so we're a loosely traded currency in a global pandemic right now, and with the U.S. dollar having fundamental problems. So there's just a lot of uncertainty when it comes down to currency markets, I guess. And we're in 2020, and if we haven't seen that already, it's the fact that we could get a surprise tomorrow, right?
Mm-hmm. Yeah, very, very true. There's one thing for sure. As we went down to 68, that was a surprise. As we ripped above 75, that was a surprise. Like this has been a year of really, really watching some interesting things in the currency. And like I said at the opening, we're very impacted by this. Like we're an exporting industry, we're an exporting country. A situation where I'm not predicting this whatsoever, but think back, it wasn't that long ago where we had a dollar because of the oil price push. We were above par. Think about the impact that has on commodity prices at the farm gate. So this kind of stuff when you talk about it in that kind of extreme, 50 cents or par, that changes things a lot when it comes to the price that people are getting.
It's always very interesting when you talk about that crude correlation in general, and the general commodity values raise the Canadian dollar, right? That's always such an interesting circular. It's like a giant circle, right? Because if our dollar was at par right now, what would our corn price be in Canadian dollars here in Ontario? And well, obviously there's a lot of other things moving on, but if the Canadian dollar was at par, that would probably mean that we're not in a global pandemic, and that would probably mean that we're still in a commodity run potentially, and that's just going to raise your actual underlying value of your commodity in the background. So there's a lot of interrelationships between the value of commodities in general and the Canadian dollar that's always worth understanding as well. So when you're hedging the Canadian dollar with long term, realize that to some extent one could argue that you're hedging yourself on one side of the boat, right?
Well, it also comes down to having an impact on the price of machinery as an example on the purchase side. We've been talking about the Canadian dollar in reference to, commodities that we're selling. But when it comes to things that we're buying coming out of the U.S., obviously that fluctuation of the U.S. dollar plays a big role there too.
So what's the optimal exchange rate? It's always been the question.
I don't know.
Right?
I don't know. Is it 75 cents? I'm not sure.
It's always a question, right? Because it has to do with inputs and it has to do with other underlying questions, right? About what's going on. So it's interesting.
I think I would have a different optimal currency valuation depending if I was buying or selling in that week. I think that's really just what it comes down to.
So you change it week by week, eh? But it's not that easy for the farm.
Yeah, it's not that easy. Hey, Matt, this has been great. I really appreciate it. Thanks a lot.
Thanks, Sean. Have a wonderful day.
I really have to admit, I am personally really fascinated by the news out there that impacts currency fluctuations. As you can see with the Canadian dollar exchange rate in 2020, predicting future values is not easy, but managing the risks are so critical. Sometimes when you think the Canadian dollar will be worth 65 cents, it finds a way to rally to 75 cents and vice versa. You just need to do the best you can to make sure you're on the right side of the hedge. That's what's critical. I hope that you enjoyed today's discussion. If you have any feedback or comments, please email me at shaney@realagriculture.com or call the Real Ag listener line at 855-776-6147. You can find more episodes of the Mind Your Farm Business podcast at mindyourfarmbusiness.com. Thanks to RBC Royal Bank, and until next time, keep on minding your farm business.